Hi everyone, my name is Fred Akon, your ACCA P4 lecturer. We're going to look at Chapter 2, Advanced Investment Appraisal, Session 1. Discounting cash flow techniques and the use of free cash flows. Your syllabus wants you to concentrate on discounting cash flow techniques in investment appraisals. What are the discounting cash flow techniques? Discounting cash flow techniques are those investment appraisal techniques which takes into consideration the time value of money and the total profitability of the project. Of course, because it takes into consideration the time value of money, it is better than the non-discounting approaches like the accounting rate of return and the payback period. Okay, your syllabus will want you to know NPV, which most of you have seen it before, internal rate of return, modified internal rate of return, you haven't seen it. Discounted payback, yes, you've seen it. Duration, you haven't seen that. Profitability index, you've seen that. Adjusted present value, you haven't seen that. I would have to emphasize that so far as P4 is concerned, NPV and adjusted present values are the common techniques that are being examined. So let's go straight to NPV calculations. Let's go straight to NPV. Okay, we're going to refresh our mind quickly on these basic ones, take a question to really solve it, and then we move on to the higher techniques. So what is NPV? Net present value is the difference between the present value of the future cash flows and the initial investment. The present value of the future cash flows and the initial investment. Okay, this is the basic definition. But at P4 level, I would have to emphasize that it is not always the case that the project will start from year 0 and from year 1 onwards. You've started making what? Money. It is possible that you're going to have an investment phase and then you have a return phase. If I have to put up a building and then rent it out, it will not take me just now to finish the construction. It might take about 1 or 2 years to finish the construction. Therefore, you have an investment phase of 2 years before you will start making rent, which is the return phase. So I normally tell students that my NPV should be calculated as the PV of the return phase cash flows minus the PV of the investment phase cash flows. Okay, PV of the return phase cash flows minus the PV of the investment phase cash flows. If you are lucky enough and the investment phase is just initial investment of year 0, that's it. But if you go there, they're giving you year 0, year 1, year 2 as the investment phase cash flow. You need to discount them to get the PV of it. Then whatever you will get subsequently, then you would have to calculate the PV to get the return phase cash flows. Okay, so NPV, basically return phase cash flow PV of it minus investment phase cash flows PV of it. When they ask you to calculate NPV, there are 3 things you will need to always look out for from the scenario in front of you. There are 3 variables broadly you need to calculate NPV. You need to get a number of years the project will run. You would have to get the relevant cash flows, and you have to get the appropriate discount factor. I am talking about the appropriate discount factor, okay, which illustrations will actually explain it in detail. What is the decision rule? If the NPV is the PV of the return phase cash flows and the PV of the investment phase cash flows, your answer as NPV could be positive or negative or 0. If it is positive, the project is a profitable one, and as such, we would have to what? Accept the project. If it is negative, you would have to reject it because it's a lost one. If it is 0, then you would have to be indifferent because you are going to break even. Whether you do it or not, you are not going to make a profit, you're not going to make a loss. So other factors beyond the financial figures may have to be considered. Okay, now, economic rate of return, which is the internal rate of return. Okay, internal rate of return is also called economic rate of return, and we all learn from F9 that internal rate of return is the rate that will make the MPV equals to 0. Is the rate that will make the MPV equals to 0. I normally find this a bit difficult to understand. What is the rate that makes the MPV equals 0, okay? For the MPV to be equals to 0, that is when we say the project has break-even. To finance the project, I would need to raise money. And when I raise the money, I would have to pay a return to the providers of the capital, which is called the cost of capital. So when I have to raise that money, at what maximum cost of capital should I be prepared to raise that money to finance that project? That maximum cost of capital is what is called the internal rate of return. So that when I raise that money at that rate and I use it to discount the cash flows, it will give me MPV of 0. And as such, I will break even. That is the worst case scenario. So internal rate of return, in layman's point of view, is the maximum cost of capital required to raise the money to finance the project. And we all know that it is calculated using the interpolation, which is this formula, Okay, the lower rate, and then the MPV of the lower rate, and the higher rate, and the MPV of the higher rate. So to calculate internal rate of return, you will need two. You will need two MPVs and their corresponding rate. What is the decision rule? The decision rule and internal rate of return is that when the internal rate of return is greater than the cost of capital, the project should be acceptable. When the internal rate of return is greater than the cost of capital, the project should be financially acceptable. Because if that internal rate of return is greater than the cost of capital you raise the money at, then it means automatically the MPV will be positive, and as such, the project will be financially acceptable. Now let's move on to discounted payback period. What is a discounted payback period? We all learn basic payback as the number of years the cash flows from the project will be used to recover the initial investment. And that was criticized on the basis that it does not take into consideration time value of money because we are not actually discounting. Okay, so a new payback is developed, which is called the discounted payback period. And discounted payback period, in essence, measures the number of years, the present value, having taken into consideration time value of money, the present value, the number of years, the present value of the future cash flows or return phase cash flows will be able to recover the investment. What is the decision rule and discounted payback? The decision rule and discounted payback is that you will only accept the project if the discounted payback period of the project is less than a target. A target, a benchmark, is supposed to be subjectively determined by the management. So without giving you a target discounted payback and you calculate your discounted payback, you cannot use it as a basis of actually deciding as to whether the project should be acceptable or not. We've just emphasized that to calculate MPV or to calculate internal rate of return or to calculate discounted payback period, you need cash flows. And which cash flows do we need? We need specifically relevant cash flows. And what are relevant cash flows? Relevant cash flows are those cash flows which will influence the decision as to whether the project should be acceptable or not. Okay? For there to be relevant cash flows, two conditions are supposed to be met. Two conditions are supposed to be met. And those conditions are that those cash flows should relate to the future and those cash flows should be directly attributable. Directly attributable to the project. Okay, So these conditions are supposed to be met. The cash flow should relate to the future, and it should be incurred or earned as a direct consequence of undertaking the project. It should be directly attributable to the project. So for that cash flow to be relevant, it should be incremental and additional. Okay? It should be avoidable. Some textbooks use variable cost. I don't normally use variable cost because when you mention variable cost, it sounds like you are saying fixed cost is irrelevant. Okay? But sometimes fixed cost is relevant. There are two types of fixed cost. We've got a specific fixed cost and we've got the general fixed cost. We've got a specific fixed cost and we've got the general fixed cost. Okay, specific fixed cost is directly attributable to the project and it becomes relevant. General fixed cost will be incurred. You cannot avoid it if you decide not to do the project. So we normally use avoidable. Of course, variable cost straightforward is an avoidable because you incur the variable cost when the activity is undertaken. So I don't normally use variable cost. I use avoidable cost. Any cost you can avoid if you decide not to undertake the project is directly attributable to the project. Wherever the project is going, it goes with it. If you do it, the cost is incurred. If you don't do the project, the cost is not also incurred. So that is relevant cash flow. Opportunity cost, any benefit forgone as a result of undertaking that particular project. What are examples of irrelevant cash flows? We are just refreshing our minds on these ones, and then we'll take a question to summarize everything. So depreciation obviously is not a cash flow. It does not involve movement of cash, so it's out of the analysis. Apportioned fixed cost or general fixed cost, as we said earlier, it is not incurred as a direct consequence of undertaking the project, and as a result of that, apportioned fixed costs or overheads are generally irrelevant. Interest payment, okay? Interest payment. Interest payment is simply irrelevant. The absolute amount of the interest is irrelevant. Somebody may raise the argument, what about if I have to raise the money to finance the project and I have to pay interest on it? That interest could be avoided if I decide not to do the project for me to go in for that particular finance. It sounds a very brilliant argument, of course. Okay, but the argument here is that, or the counter argument here is that the cost of capital we are going to use, okay, that interest is part of that cost of capital we are using as that discount factor. And as a result of that, if you use the interest as part of the discount factor and you also bring the absolute amount of the interest as part of the cash flows, you have duplicated the effect of the interest. So as long as the interest is part of the discount factor, you do not have to bring it as part of the cash flow. So that is the reason why we do not have to bring in the interest in the cash flows. It's already included in the discount factor. Sunk or past costs. The cost had already been incurred. It does not relate to the future. Okay? It's not avoidable. You have already incurred it. And as such, it becomes what? Irrelevant. Notional cost. Notional cost is very close to opportunity cost, so watch out. Notional cost is very, very close to opportunity cost. Opportunity cost is an identifiable benefit forgone as a result of you undertaking the project. So for instance, if the project will be undertaken in this room, and this room could be rented out for £1,000 per year, if I do the project here, at the same time, I cannot rent it, so I am foregoing 1,000. Be with me here. It becomes an opportunity cost if there is somebody available to rent the place. If there's nobody available to rent the place, it becomes a notional cost. Why? Because whether I do the project or I don't do the project, there's nobody anywhere who is coming to rent the place. So that 1,000 will not be got. It's notional. It's in here that I could have got the 1,000. Whether you do the project or you don't do the project, nobody comes in to do it. And as a result of that, you won't get the rent of the 1,000. It becomes a notional. But if there's somebody there ready to rent the place, if you do the project in the room, you are foregoing the rent. That becomes an opportunity cost, and that is relevant. So watch out for those two. Working capital. Another aspect of the cash flows is working capital. If you are doing a project, you don't need only fixed capital. You also need capital to run the business on day-to-day or the project on day-to-day basis. And that capital you need to run the business on day-to-day is what we are referring to as working capital. Okay, but remember, whatever working capital you are going to put in, you would have to get your money back. Whatever working capital, unless otherwise the examiner state it. If the examiner don't state anything, the assumption here is that whatever working capital, the inventory will be sold, the receivables will be collected, the payables will be paid back. Therefore, you will be able to recover whatever working capital you put in. If the working capital increase, it means you have invested more. If your working capital decrease, it means you have actually recovered the amount you put in. So now let's move on to inflation and project appraisals. One other aspect of the cash flow is inflation. We all know inflation has got the effect of increasing prices. So inflation will increase your revenue, inflation will increase your variables and your fixed costs. I would have to emphasize here that some of you have made up your mind that fixed cost is fixed. So fixed cost cannot change with inflation. It is a wrong analysis. Fixed cost is a cost that does not change with the output within a relevant range. Therefore, fixed cost can change with the level of inflation. It doesn't change with the level of output within the relevant range. So when there is inflation for fixed cost, please remember to increase the fixed cost by inflation level. Inflation has also got the effect of increasing your discount factor. We said discount factor is the cost of capital. So if discount factor is the cost of capital, then where there is inflation, providers of capital, their capital will be eroded by the amount of the inflation. Therefore, they would like to transfer the inflation effect on the cost of capital or the discount factor. So inflation has also got the effect of increasing your cost of capital. So when there is inflation in the question, you would have to relate it to how it will affect your revenue, how it will affect your cost, and how it will affect your discount factor. Okay, and these are the terminologies we would have to refresh our minds on. Money cash flows. What do we mean by the cash flow being in money terms and the cash flows being in real terms, money and real? Cash flows being in money terms means those cash flows are already inflated. So when I inflate the cash flow, we call it money or nominal. When the cash flow is not yet inflated, we call it real. Don't confuse reality and real. The reality is the cash flow is already inflated. Reality goes with money or the nominal. They also call money or nominal terms. Money or nominal terms. Okay, so if the cash flows are inflated, they are nominal. If the cash flows are not yet inflated, they are simply real. Now let's see relationship between money interest rate and real interest rate. Okay, we are supposed to calculate the NPV, and we all said you need number of years, you need the relevant cash flows, and you need the appropriate discount factor. What do we mean by the appropriate? The appropriate discount factor should be that discount factor or cost of capital that is consistent with the cash flows you are about to discount. So if my cash flows are nominal, which means they are after inflation, my discount factor should also be after inflation. And if the cash flows are real, which is before inflation, then the discount factor should also be real. But most often than not, the examiner will give you maybe nominal cash flows and you are also giving the real discount factor. It's your job to convert to bring them to par. Okay, so how are we supposed to convert from nominal to real or real to nominal discount factors? And that is what Professor Fisher gave to us. According to Fisher equation, which is given on the ACCA formula sheet, 1 plus money rate should be equals to 1 plus real rate multiplied by 1 plus inflation rate. By point of attention, if you go to the ACCA formula sheet, they quote it 1 plus I is equals to 1 plus R, 1 plus H. Okay, we quoted it 1 plus M is equals to 1 plus R, 1 plus I. Okay, for so far as we are concerned, this is the money rate, and this is the real rate, and this is the inflation rate. Is it different from what ACCA had quoted up there? It's not different, okay? You can use whatever letters that you want as long as you understand the mechanism. We all said that when something is in real, it's not yet inflated. So if I want to inflate it, I have to multiply by the inflation effect. So when I multiply the real effect, when I multiply the real by the inflation, it should give me after inflation. So this formula ACCA had given to you, this I is not inflation, this I is still the money rate. This R is the real rate. The H is the inflation rate. So watch out, okay? Watch out. So that is basically something that I will need to bring your mind on. So let's take this simple example to convert from one to the other. A company has a nominal cost of capital of 18% per annum. If inflation is 6% each year, calculate the company's real cost of capital to the nearest 0.01%. Okay, so that is basically the case. We need a real rate. So if we need a real rate, we code the formula. So I will say 1 point, if the nominal rate is, 1 minute, if the nominal rate is 18%, 1.18 should be equals to 1 plus R, and then 1 point inflation rate of 6%, so 0.6. So my R should be 1.18 divided by 1.06 minus 1, and that is what is given approximately 11.32%. 11.32%. Okay, so that is the case. Now let's move on to the next level. Okay, example AP. A project requires an outlay of 1.5 million in year 0 and will repay cash flows in real terms, today's terms, meaning we have not yet inflated it, as follows. Year 1 up to year 3, the company's money cost of capital is 50.5%. Money cost of capital means that cost of capital is after inflation. These cash flows are before inflation. Calculate the MPV if inflation rate is 5%. If I have to calculate the MPV, you need the number of years, which is year 0 up to year 3. I need relevant cash flows. There are two ways you can handle this. Either I will keep everything in real and discount the real cash flows with real discount factor, or I will inflate the cash flows and I'll discount it using the nominal discount factor. So method 1, we are keeping it at real. So we brought in the cash flows, real cash flows. Then because we had brought real cash flows, we cannot discount it using the 15.5% because that is in money terms. Therefore, we have to convert from the money terms to the real terms, just as we did. So the money terms is 15.5, so it's going to be 1.155 here, divided by the inflation rate of 1.05 minus 1, and that is going to give you 10%. Okay, so if you haven't got a 10%, all what you have to do is you can read from the table or you can calculate it. As we know, discount factor is always 1 divided by 1 plus R raised to the power n. That is what they did here for you. So you can decide to pick it from the table, and discounting these real cash flows with a real discount factor of 10% will give you MPV of 423.9 pounds. Okay, now let's see. The second method is you inflating the cash flows using the inflation rate and then discounting it using the nominal discount factor. All what we're saying here is you would have to compare like against like. So the appropriate discount factor is telling you compare like against like. If my cash flow is that, my discount factor should be that. That is the meaning of the appropriate. So you don't pick any discount factor. You should be consistent with the cash flows. So if my cash flows are nominal, then I can use the nominal discount factor of 15%. And as such, how do I get a nominal discount factor? I would have to inflate it. Okay, so they gave us the real of 670, 500, and 1,002, subject to inflation of 5%. Because all these were in today's terms, they are referenced to today, year zero. So in a year's time, this one should be 1.051, 1.052, and 1.053. When you get a discount factor, MPV should be the same as that. Okay, so whichever way that you use, the MPVs are supposed to be the same. Now let's see the next, taxation and project appraisals. Taxation and project appraisals. Okay, another aspect of cash flows or relevant cash flows is tax, because we said relevant cash flows should be incremental. As a result of undertaking this project, there is that likelihood that the project will result into a profit. And when it results into profit, we would have to pay an additional tax. And that additional tax we would have to pay becomes a relevant cash flow. Therefore, it should be taken into account. And anytime you have to deal with tax, you would have to calculate the tax on the cash profit, which is sales minus expense. You have to also get the tax savings on capital allowances, and you also have to respect the timing, because we are dealing with cash flows. And once we're dealing with the cash flows are prepared on the basis of receipts and payment. And if it's receipt and payment, it's when the cash is supposed to go out and when the cash is supposed to come in. So now let's take this question to illustrate whatever we have said so far on basic investment appraisals. DataCo is considering a project whether or not to commercialize an innovative muscle toning device, MTD, that will be used in the treatment of sporting injuries. It is expected that the commercial life of MTD will be 4 years, after which technological advances will bring more sophisticated devices to the market, and the sales of MTD will fall to virtually zero. 8 million has been spent in developing and testing the device over the past year. Initial market research has been conducted at the cost of 2.5 million and is due to be paid shortly. Information on future returns from the investment has been forecast to be as follows: year 1 up to year 4. Unit demand, selling price in current price terms, variable cost in current price terms, fixed cost in current price terms. Selling price inflation and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed production overheads, which are wholly attributable to the project. The production equipment for the new device would cost 120 million, and an additional initial investment of 20 million will be needed for working capital. The equipment is expected to be sold at the end of 4 years for 10 million when the production and sale ceases. The average general level of inflation is expected to be 3% per year, and working capital will experience inflation of this level. Capital allowances, tax allowable depreciation on a 25% reducing balance basis could be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance will be claimed in the 4th year of operation. DataCo has a real cost of capital of 7.8%. Calculate MPV, internal rate of return, and discounted payback period. Okay, now if I have to calculate MPV, however big the question is, I would have to group it into 3 main variables. I need a number of years, and the question told me the project is there for 4 years, so I've got 1 variable. I also need the relevant cash flows. What is the question telling us? 8 million has been spent in developing and testing the device over the past year. Once it has been spent, that is a sunk cost, so I do not have to bother myself with it. Initial market research has been conducted at the cost of 2.5 million and is due to be paid shortly. Even though it is due to be paid shortly, the work had already been done. So this could be called a committed cost, which some people put it as part of what? Sunk cost. It's a committed cost. The work had already been done. So whether you decide to go ahead with the project or not, that cost is already incurred. You are committed to pay. So that one is also what? Irrelevant. So these two figures, I don't need them. For the purpose of tax, I would have to start with my revenue items. So what will I do? I will open my table and I will say the project is going to go for 4 years, so 0, 1, 2, 3, and 4. I leave space in case something should go to year 5. For the purpose of tax, we would have to start with our revenue items. So I will start with my sales. I'm keeping everything 3 zeros up. Okay. Now, for the purpose of tax, we start with our sales items or revenue items. So I leave space, go down there, and try to do workings on sales. So this will be the workings. Workings 1 is going to be with the sales, year 1, year 2, year 3, and then year 4. Okay, I need my selling price. According to the question, selling price is given at 2,000, 2,200, 1,600, and 1,500. But the question told us that these selling prices are in current price terms, meaning they are in today's terms. And selling prices are subject to inflation of 5%. So there's the need for me to inflate it. So I would say inflation 1.051, 1.052, 1.053, 1.054. Okay. And when you multiply, you're going to get selling prices inflated of 21, 2426, 1852, 1823. And don't forget, you need to multiply by unit. It's 20, 70, 125, and then 20. And you multiply to get the total sales figures, 42,169,820. And then 231,500, 36460. And then you move yourself up to go and calculate or put in that template. So I will say 42,000 sales, 169,820, 231,500, 36460. You do the same thing for variable costs. So I go and do workings number 2 is on variable costs. Year 1, year 2, year 3, year 4. I will say variable cost per unit. The variable cost per unit giving us 900, 1,000, 1,020, 1,020. That is also before inflation, because they said it's in current price terms. Variable cost inflation is subject to 4%. So I will say 1.041, 1.042, 1.043, 1.044. Okay. When you multiply 936, 1082, 1147, 1193. And then you bring your unit here 20, 7125, and then 20. And when you multiply, it's 18,720, 75,740, 143,375, 23860. Okay, you move yourself up to get to the template. So remember, it is an outflow. So once it is an outflow, you have to deduct. So 18,720, then 75, 740, 143,375, and then 23860 minus. Then you have got a fixed cost. Given this question, the same fixed cost is 10 million subject to inflation of 5%. fixed cost can increase with inflation. It cannot increase with output within the range. So we can increase it. Am I supposed to do workings? No, because this is 10, 10, 10, 10. So I'll pick my calculator and I will say 10,000 here times 1.05. That is 10,500 minus times 1.05, 11,025. And then press my equal sign 11576. Press the equal sign 12155. Okay, now my cost is over. I've got my variable cost, fixed cost, sum to get the cash profit. And the cash profit is 12780, 83055, 76549, and then 445. This is your cash profit. Normally, you can decide not to bring it there. Okay? If you get your cash profit, you would have to think about tax. It's a template. What is tax? Question is telling me tax is 30% payable 1 year in arrears. You have to respect the timing. So 30%. So 30% of 12780 will go to year 2. And that is going to give me 3834. Then 83055, 30% of that will give me 24917. 76549 times 30% is giving 22,965. And then this is the time I will create my year 5. 30% of the 445 is giving 134 minus. Okay, then you would have to remember your tax saved on capital allowance. We would have to leave space, go and do the calculation on tax savings on capital allowance. So workings 3, tax saved on capital allowance. Okay, I'm not going to use that long approach. I'm using the shortcut approach because that is what you are more likely to be using in the room. So what is the capital allowance principle? Question said at this level that your capital allowance, tax allowable depreciation, is 25% on reducing balance basis. Okay, and remember, capital allowance cannot be claimed on working capital. Capital allowance cannot be claimed on working capital. Working capital is current asset minus current liabilities. Working capital allowance should be claimed only on non-current asset. Okay, like this equipment. And the cost of the equipment is 120 million. So how do I calculate the tax savings on capital allowance? One, I will say the cost is 120,000 multiplied by the reducing balance of 25% multiplied by the tax rate of 30%. And then this will give me the savings. So 120,000 times 0.25 times 0.3 is 9,000. Okay, then when I come to year 2, because the capital allowance rate is 25% reducing, if something is reducing by 25%, it should reduce to 75%. So this savings will reduce to 75%. Okay, and as such, I will multiply this by 0.75, which is 6750. And year 3, that 6750 will also reduce to 75%, and that is going to give me 5063. And be with me now. When you come to year 4, we find the year 4 savings as difference. This is the common sense. The taxman will give you capital allowance based on qualifying expenditure. You bought the asset at the cost of 120,000, and according to the question, there is a residual value at the end of the 4th year of 10 million. Therefore, if you bought the asset at 120,000 and at the end you sold it for 10,000, you didn't incur 120, for which you should be given capital allowance on the whole 120. The maximum the taxman can give to you is 110, because effectively you have incurred 110. So the total allowance you can save is the 110 multiplied by the tax rate of 30%, which is going to give you 33,000. So this is what you can claim for the whole of the asset life. However, you've claimed this, and that for the first 3 years. So how much will you claim in year 4? So 33,000 minus 9,000 minus 6,750 minus 50,63 is going to give you 12187, sort of. And that is the tax savings on that capital allowances. So let's bring ourselves up here. So that one too, you need to respect is tax. So 1 year in arrears, you put the 9,000 in year 2, and then 750 year 3, 50, 63, and 12187. Okay, having done your tax savings on capital allowance, you are left to do with the capital items, which will include your initial investment of 120,000. There is residual value, which will be got at the end of year 4 when you sell the asset at 10,000. Then the question also said there is a working capital. This is the MPV template, basically. Okay, working capital. Let's go and read information about working capital. Question told us, and an additional initial investment of 20 million will be needed for working capital. So 20 million will be needed for working capital. Then we will say that we would have to include the effect of the working capital. But the question is also telling us that the average general level of inflation is expected to be 3% per year, and working capital will experience inflation of this level. It means your working capital will also increase by that 3%. Therefore, let's go straight and go and do the workings on working capital, and then we will come back. So workings, I think 4. So my workings 4 is going to be on working capital, year 0, 1, 2, 3, and 4. Okay, my total working capital in year 0 is the 20,000. This is subject to 3% increase. So 20,000 times 1.03 is 2,600 times 1.03 is 21,218. Press the equal sign, 21,855. Somebody will ask, why am I not doing anything in year 4? Year 0 is not a year. Year 0 is now. 12 months after now will put you to year 1. So this is the first 12 month, 12 month, 12 month, 12 month. So the working capital I put in year 0 is for this 12-month period to year 1. Working capital I put in year 1 is for this 12 month to year 2, and so on. So what I put in year 3 is for this 12 month for up to year 4. If I put something in year 4, it will take me to year 5. The project is dead at the end of year 4. However, there is another school of thought which normally also puts it there in year 4 for the sake of going to year 5. If you see such solutions and you have done yours this way, you are not wrong. You are actually right. There are these two schools of thought. What is my recommendation? In the examination room, I will recommend you use this because you haven't got the time, unless maybe the examiner states otherwise. Okay, so if these are the total working capitals, this is 0, then what will be the cash flow? We want the incremental. I put in 20,000. It means I invested. It's a cash outflow at the beginning of year 1. At the end of year 1, my total working capital is 20,600. What is it telling me? I have brought in additional 600. And the next time is gone to 21,218. What's the meaning? It has also increased. How much has it increased by? It has increased by 618. You are bringing in more. And the next one is 637. And from here to there, it's gone to 0. So it means your working capital has decreased. And as we said, if the working capital decreased, you have recovered your money. And as such, it's 21855, a cash inflow. So let's go up there, and then we bring the working capital values. So this is 20,000 minus, and then is given 600 in year 1, and then 618, and then 637, and we recoup 21855. And these are your net cash flows. So sum them up. This is giving you 140,000. And the next one is 12180 87603 57745 14398 and then 12053. Okay, once I've got these net cash flows, what next? I would have to bring the appropriate discount factor. What discount factor should I bring? The discount factor I should bring should be consistent with the cash flows I have got. These cash flows, they are after inflation because I have inflated the sales, the variable costs and all that. So if they're after inflation, then the discount factor I will need should also be after inflation. I go to the question and I ask the question, what discount factor have you got for me? The question says, I have got real cost of capital of 7.8%, but there's general inflation of 3%. Therefore, I cannot use the real. I would have to use what? The nominals. Convert from real to nominal using the Fisher equation. So now let's quickly go and do that workings. So I'll say workings 5. Nominal discount factor. 1 plus m is equals to 1.078. The real rate is 7.8%. The general inflation rate is what goes into cost of capital. If you look at the question, we've got inflation for selling price, variable cost, and fixed cost. Okay, so when you want to make that adjustment to get a nominal, you want the general or the average inflation, which the question said is 3%. Therefore, what is your money rate? And your money rate is going to be the 1.078 times 1.03 minus 1, which is 11.034%. So approximately 11%. So if it's approximately 11%, we go up there and then we go and do the 11%. So this is the 11%. 0.90, 0.812, 0.731, 0.659, 0.593. Okay, 140,000 here, and this is 10,974, 71134, 42212, 9488, 7148, and the MPV is straightforward 956. So as long as the MPV is positive, the project should be financially acceptable. So that is the first bit of the requirement, which says we should calculate MPV. The second bit is the internal rate of return. Okay, to calculate internal rate of return, we need 2 MPVs and their corresponding rate. I know some of you want to get one positive, one negative, but the whole idea is if you get 2 MPVs, being it 2 positive, 2 negatives, or one being positive, one being positive, one being negative, it doesn't matter. You have to come to the same thing. But ideally, if you are able to get one positive, one negative, it's fine. It's technically a straight line like this. So this is your MPV line. This is the R line. If I use 5% and I get this MPV, if I use, let's say, 10% and I get this MPV, I can join these two like that. If I join them, this is where it intersects that line. So when I join these two, this is where it intersects. This is the IRR. So assuming I use 5% to get that, I use 6% to get that, I can also join these 2 lines and then it will meet this point. So you don't necessarily need 2 positive or 2 negative. Whichever 2 that you get, put in the interpolation formula and you'll be fine. So we are going to calculate the internal rate of return. We have already calculated the MPV using 11%. So if I need another MPV, or what I will do is to assume another discount factor. So what discount factor will I use? Because the 11% gave me a positive MPV. If I want to get a negative, ideally, what should I do? There's an inverse relationship between the discount factor, which is cost to you, which is of course cost of capital, and the NPV, which is the profit. So if the NPV at 11% cost is profit, if I want to make a negative NPV, which is loss, what should I do? I would have to increase the cost. So we went up to 13%, brought the 13% discount factor, got NPV of 5240 negative. So all what you have to do is you choose your own first discount factor, get the NPV. Then the second one, based on the first NPV, if you had a positive NPV and you want negative, increase your cost of capital. If you had a negative NPV and you want positive, reduce your cost of capital. So here we increase it to 13%, discount the net cash flows at that 13%, got the NPV of 5240, and then we put it in the formula. The lower rate is 11%. Lower rate 11% gave us 956. 956 again plus the higher rate NPV. Y plus negative negative, and the higher rate and the lower rate, which will give you this. And that gives the internal rate of return. What is the decision rule? As long as the internal rate of return is greater than the cost of capital, the project should be financially acceptable. The last bit is the discounted payback period. Last bit is the discounted payback period. How do we calculate discounted payback period? We said it measures the number of years the present value of the future cash flows will be able to recover the initial investment. So these are the cash flows, net cash flows, discounted it at what? 11%. It's because of illustration. In the examination room, you had already calculated the NPV up there. You have all these figures. Don't go and copy that. Okay, so having got the present values, how many years are we going to use these cash flows, present values of these cash flows to recover this investment? So we started with this 114, and then we're going to take the 1097.4 out of it to get that. We did that until it becomes 0. This from that gives you that. This from that gives you that. And then this from that gives you that. So come the end of year 4, it is left with 6192 to recover. But year 5, I made what? 7148. It means I didn't use the whole of year 5. I just used what? Some period. So I have to do that proportion. So if the whole of year 5, I made 7148, when within year 5, I will make 6192. Do that proportion. So my x should be equal to 6192 divided by 7148. And that is what is given 0.87. So it will take me 4 plus this period, which is 4.87 years to recover the investment. Should we accept this project? The answer is it depends on the company's subjective target discounted payback. This question didn't give us any subjective target discounted payback. So your answer to the examiner is that you are not in position to form any conclusion as long as you haven't got a target to compare it with. And that is basically the discounted payback period. Thank you very much.